Me too. What time you're flying?
My flight is 6 p.m.
Me too. I'm in Dubai now.
Oh, okay. Yeah. So Emirates, yeah?
Yes,
Okay,
5:45.
guys, we are going
Yes.
live
Yeah, yeah.
now. Sorry,
I'll see you
sorry.
at the airport.
Okay.
We have the Me Too movement on the phone this morning.
I want to go to Riyadh as well.
Well, we're feeling a little bit left out, but I think you have to be gorgeous, incredibly smart, and have an awareness of who Prince Abdulaziz is, and then you get to go. Um, anyway, that's another story, another bit of crack, another joking around. Welcome. Good morning. It is the Daily Energy Markets podcast on Monday, February the 19th. We have Brent crude oil trading down this morning in Asia, down about 0.75%, but nonetheless holding very close to $83 a barrel on Brent, with WTI about $5 behind. So a good week last week, one would say, with Brent holding its gains from the previous week after a series of up and down weeks. Let's welcome Omar Najia, Global Head of Derivatives at BB Energy. Omar, your thoughts this Monday morning after a week of somewhat consolidation last week, shall we call it?
Well, I mean, last week everybody was saying last week didn't consolidate. Last week the market moved up about 2.5%. So just saying. So last week you were saying, or everybody was saying that something about China is going to basically bring everything down, and I don't know what, blah blah. So the market went up. And looking at this week, I think the market is going to do something else, which is again go up. So we're bullish. We like the market. We think the world is inflationary. We like equities. We like Bitcoin. We like oil. We like. So upwards and onwards. And we wait to see what happens in terms of. So I think basically OPEC plus cohesion is rock solid. They want higher prices. The dollar I'm worried about, etc. So I don't see any reason, and with all the geopolitical stuff going on, I don't see any reason to be strategically short the oil market. So we are bullish.
Bullish. Amina Bakker, Senior Research Analyst at Energy Intelligence. I think that's the first time I've had the chance to make that new job title introduction. Does that mean we can't ask you about OPEC anymore, that there is some lost OPEC senior correspondent somewhere wandering around the streets of Dubai, or we get to ask you the same questions? But Amina, looking at all things OPEC, if you would, at least putting on your old hat and so I'm sure part of your new hat, that this is a quarter in which OPEC cuts are to be implemented, greater cuts than before. How is that looking? Are they meeting their expectation? Will that continue beyond Q1? Your thoughts?
Well, you can absolutely ask me about OPEC because it's still an area I'm very, very much covering in addition to all the Gulf region. So in terms of the OPEC cuts, they've proved to be effective so far, Sean. I mean, we're seeing inventory levels that usually build up during the first quarter drop. Initial estimates see that inventories have dropped about 60 million barrels for January. We're still to see how the first quarter pans out. As you mentioned, Brent is holding strong in the 80s, which is great for many of the group members. As you know, that there's a kind of milestone coming up for the group. They're expected to decide on what to do with the latest tranche of voluntary cuts of 2.2 million barrels a day, whether to extend it for another quarter or to decide to bring back some of that supply gradually in the market. That decision is expected to happen by the first week of March. According to our estimates, at least at Energy Intelligence, we still see growth in demand around 1.2 million barrels a day, which is much below what OPEC expects. They're a lot more bullish. They're still holding on to the 2.2 million barrel per day growth. If that 2 million barrel per day growth does indeed happen, and they're expected to happen in the second half of the year, it means that it leaves space for the OPEC plus group to bring back some of that supply into the market, which will happen on a pro rata basis and will happen gradually to avoid any kind of shocks to the market.
Dr. Sarah Vakshuri, founder and president of SVB Energy International, while in Dubai today, is usually based in Washington, D.C., when not on an airplane, of course, because I think nobody circumnavigates the world as much as Dr. Sarah. But Dr. Sarah, I wanted to get your thoughts on the non-OPEC plus supply and where do you think that's going? I mean, if we have a sort of an anemic 1.2 million barrels a day of demand growth in this year after double that last year, where is the non-OPEC supply going this year? Will it take up all of that 1.2? Your thoughts looking out at non-OPEC plus supply?
Very good question, Sean. Yes, actually, their expectation that the market is somehow balanced because while we're having the demand increase, I also want to point out that last year, many gurus in the market were expecting a recession. But what we're seeing is a healthy, strong demand growth. But on the other side, we also expect a supply growth that a lot of it coming from countries like US, Guyana. Looking at it, if the market is going to be balanced or not, as Amina mentioned, there is a discrepancy between the forecast for demand growth. We have as low as 1.2, we have 1.5, we have 1.9, and the maximum being about 2 million barrels per day. So we are seeing non-OPEC growth, especially from US and Guyana, Canada also. We have some from Brazil to come to the market. So again, depending on where you go, if we put around 1.5 consensus among all different data for demand growth, we could kind of expect a somehow balanced market. But
just looking at that Americas list you outlined there, Canada, the US, Guyana, and Brazil, obviously they had a significant year last year in adding capacity. What does it look like in its total that they could add this year? Could it be over 1 million more?
Well, I think that it depends that, again, because we are not the source that we would make that data, but depending on different sources, their expectation between 1.2 to even, again, 1.5 million barrels coming up as a sum from this region.
Omar, just to bring up your favorite subject that you started with this morning, China. China tourism revenues in China during the Lunar New Year, which just ended on Saturday, surged by a whopping 47%, which even surpassed 2019 levels. So big domestic travel boom there. As you look out, do you think this could be the trigger that reignites the Chinese economy, this post-COVID sort of recovery that we've been waiting for?
If you look at China, you've got to understand that there's two ways to look at China. One is Western reporting, two is Chinese reporting. They do stuff basically in English. Those two things are like black and white, right? It's the same with everybody's basically selling. The information about China in the West is basically that China is stuffed. They're going down the toilet. Everything is imploding. And it's been the same thing since the pandemic, right?
It's the 8th century, I think.
Yeah, exactly. So at the end of the day, at the end of the day, you know, you have to, you know, it's like, what are you going to believe? Your lying eyes or what we tell you? So my lying eyes.
Well,
say
Chinese
China
data
growing.
today is telling us these points, that there's obviously a big recovery in domestic travel over, and that's China's Ministry of Culture and Tourism putting out those numbers.
China's been growing for 50 plus years, and it's going to continue to grow. China doesn't have the problems. All countries have different problems, but the problems that we have in the world economy stem mainly from the US.
But you could have a situation. I mean, this is the question inevitably, the duality. You could have China being perfectly economically healthy, like you might say America is, and yet no oil demand growth, right? I mean, the US economy is thumping along, but oil demand growth in Europe and America is flat to declining, as in most mature OECD countries. The question is China now one of those?
No, I think basically the US economy is not thumping along. I think basically that the equity market in the US is thumping along. And the difference between those 2 points is that because I think basically people are looking for a place to put their money, and therefore, they're worried, and it's like an inflationary thing. So 7 stocks in the US stock market hold up everything. So I don't agree that the US economy is thumping along. I don't agree that, if you look at Germany.
But the point is generally that the OECD economies are flat in oil demand growth, not energy demand growth, but oil demand growth. And now China, as a maturing economy, may also be approaching that. So yet the economy could be doing well, lots of people traveling, but yet oil demand growth could plateau.
Yeah, so basically, look, yeah, possibly. But let me put it to you this way. If you ask me what oil prices are going to do next 3 years, 4 years, that kind of stuff, I think we're going to see not only new all-time highs, but maybe like a doubling of the price, 200, 300, et cetera, et cetera. So, all this stuff about, this economy is faltering and that economy is faltering. You have basically a lot of issues with supply. You have a lot of issues with shale. You have a lot of issues with investment. You have a lot of issues with refineries, with shipping, with all that kind of stuff. So, you kind of have to take like a more kind of, a bigger view. It's the same with LNG. People will go, or Henry Hub, people will go and say, look at Henry Hub prices, they're really low. Jesus, that means everything's going to crater. It's, really bad. I've seen Bloomberg issue articles saying the same thing. Henry Hub is going to lead to WTI going to 40. And it's the other way around. If Henry Hub is at the lows that it's at, it's telling me to buy it, not to sell it, to actually buy it. So
it seems to be at multi-decades
opinion.
low with the Henry Hub, given the not a very cold winter. Amina, I wanted to get your thoughts on the comments made by His Excellency, His Royal Highness, rather, Prince Abdulaziz last Monday at the conference in Dhahran regarding why Saudi didn't proceed with the 1 million barrel a day capacity increase. And he also made reference to why should we be a country that maintains very expensive idle capacity when other countries don't. I think the words he used, respect it or appreciate it or something like that. Ever since I've been trying to sort of interpret those comments, you know him pretty well. What was he saying there? Is he signaling the end of the swing producer role for Saudi Arabia?
No, he wasn't swinging the end of the swing producer role. It's kind of a fine line between the traditional policy where you remember Ali Naimi always used to say that the kingdom will keep 1 to 2 million barrels a day of spare capacity for the security of the global markets versus keeping spare capacity for market management. So what he's saying here is that the kingdom is not appreciated and therefore will no longer keep that buffer for global security. However, they will keep a buffer which makes sense to them, whether it's 1, whether it's 500,000, whether it's 2 million, for market management purposes. Sean, as you've seen, just globally, we're seeing a lot of countries in the world put themselves first. National priorities have come first. So with Saudi, it's Saudi first. With the US, it's the USA first. With India, it's India first. So national priorities have really taken precedent over this idea that global supplies or global spare capacity needs to be there for security purposes, especially at a time where it's not really appreciated by the world.
What does that mean from a volume point of view? Of course, they abandoned the plans or suspended, at least for now, the 1 million, which was new capacity, but they still are carrying 3 million barrels of idle capacity. Does this conversation, these comments signal that 3 might be reduced to 2 or 1 or?
That capacity is just up to the discretion of the leaders. At whatever point in time they feel that they need a buffer for market management purposes, then they will do it. They are not keeping in mind that they need to keep a fixed buffer for security purposes. But at the same time, Sean, I mean, they are investing in capacity. There's a misconception that if they've abandoned the plans to 13, therefore they're not putting money into maintaining capacity, which costs a lot of money. Maintaining that 12 is still ongoing. Plus, they are using, the plan is to use non-associated gas from Jafurah, which is going to displace 1.4 million barrels a day of liquids, which is currently burdened in the kingdom. So you get that additional capacity, which they could potentially export.
Sarah, I know you spend quite a bit of time in sub-Saharan Africa. Perhaps you could give us some thoughts of where the West African oil producers are. We had Angola drop out of OPEC plus, or OPEC, as they were a full OPEC member in December, after that meeting in which it seemed to be a little bit testy about quota compliance. Where is West African countries, particularly Angola and Nigeria, in their ability to maintain capacity? As Amina said, it's very expensive to maintain capacity, never mind grow it. A, why do you think Angola dropped out? And B, what is the outlook for those African countries this year?
So I try to be brief to respond this, because then I want to go back to what we discussed before this. So in terms of West African countries, as you said, yes, we're seeing that they are producing under their capacity and has been challenging for them to maintain their capacity. And we have seen that push from even other OPEC countries to revisit their capacities. I mean, there are
their
changes.
Quotas.
Yes, their quotas. And something interesting is now American oil goes to Nigeria, because Nigerian energy demand, especially for fuel, is increasing for gasoline, and they are importing from US. But if I want to kind of allude a bit more to the few significant things that both Omar and Amina made, it's something that you're dealing with now is this huge data discrepancy in the market, and those perceptions that in the market between the forecast and major reputed places that they are forecasting and creating expectations, or helping guiding the market expectation for both supply and demand. For instance, last year, there was this common narrative of recession in 2024, which obviously indicated lower demand. However, now we're in 2024 and we see a healthy demand, a demand that is not necessarily even based on Chinese demand to grow. Yes, China is growing the demand, especially for oil and petrochemicals, because they are producing more. But we see that even out of China, we have a healthy demand growth. And I like to draw everyone's attention to this recent paper that Federal Reserve published on messaging and how OPEC's messaging impacted the market. But I think that not just the messaging and those data in the market that create expectancy in the market and move those investments and create different assumptions need to be a bit closer or more realistic. Because as we see, again, both on a supply side and demand side, many things have been wrong. Obviously, there are revisions constantly being done about some very interesting things. For instance, we had, with regard to question that Amina answered, when the Russia war broke, we had the late Secretary General of OPEC, His Excellency Bart Window, immediately saying that no one can cover Russia's share, and Russia's share is not going to be misplaced. But we had IEA to projecting that 3 million barrels of Russian oil is going to be misplaced. What happened? We saw US start withdrawing from SPRs and inventories, but today, not only Russian oil hasn't been misplaced to that certain amount, but also Russia's economy had growth. So seeing these revisions as an aftermath actually has created some misconceptions in the market. And I think that huge differences between assumptions and that huge discrepancies that we can see between different data producing market, that has created a problem. Because again, you ask me, what do you think the supply is going to be, let's say in America, or how much the demand is? We have Amina from Energy Intelligence, 1.2 on demand growth. We had to extreme of 2 million barrels 1.5, and this same discrepancies are with regard to supply, with
Well,
regard
certainly you're going to have a lot of fun in Riyadh this week because all of those people and all of those parties who made all of those wide predictions. I mean, the Amina Energy Intelligence is 1.2 with the IEA, and then of course 2.2 with OPEC. Let's go to the survey question today. And then maybe we can talk a little bit about that meeting in Riyadh. The question today is the China one, all for Omar. Tourism revenue in China during the Lunar New Year ended on Saturday, surged 47%. Of course, that's a very big number when you consider, I said last year, it was still just coming out of COVID in China. So not surprising that year on year, big jump, but surpassing even 2019, first year in 5 years that Chinese New Year has happened during a sort of a COVID-free window, if you like. So my question is, will this be the trigger to reignite the Chinese economy and drive prices to $90 by the end of Q1, drive Brent prices to $90? That this China is the China wake up, and that it could be the momentum. Omar himself saying that expects prices to go higher this week as they did last. Is this the trigger, China finally waking up after COVID? Yes or no? I mean, I wanted to get your thoughts and expectations for this meeting in Saudi and Riyadh this week. It's the International Energy Agency who have forecast, as you have at the Energy Intelligence, a demand growth of only 1.2 million barrels a day. OPEC Plus, which is forecast at 2.2 million barrels a day demand growth, and the IEF, who I don't think do a demand forecast. Maybe I'm wrong, but so I'm just wondering, for that discrepancy has also come since the last symposium of these three groups with a lot of mudslinging, because it also in the interim period has come with a forecast for peak oil demand by IEA at 2030 and OPEC Plus at 2045. I'm just wondering, what's your expectations for this gathering? All of these differences harmonious? Will they meet in the middle? Is there expectations at all? But these two discrepancies, as Dr. Sarah's indicating, are kind of confusing the market a bit. Your thoughts for the meeting in Riyadh?
Well, the meeting in Riyadh is just a set of dialogue, really. Is for everyone to talk together, to explain why there are discrepancies, where they're seeing the weakness, where they're seeing the pickup in demand. I just want to add in another number to the mix here. Aramco, for example, have growth for this year at 1.5 million barrels a day, which is kind of close to the 1.2, 1.3 range. So even between OPEC and Aramco, there is a difference. So it'll be really interesting to hear from everyone who are there to share their views. I mean, this is just a gathering where there's a lot of discussion around the numbers. There isn't there's no consensus going to come out of this and say, okay, it's finally this number or that number.
Well, it could be useful to get a granular understanding as to how they've arrived at their numbers.
Sure, but they don't, nobody's ready to break down their methodology. That's something that's kind of kept discreet, but at least views on, to hear from OPEC where they see this extra demand from, whether they see, there's another theory, for example, that there's decoupling between GDP and demand growth, that you're going to get a lot of people driving, consuming jet fuel, et cetera, which doesn't necessarily link to GDP. So maybe some agencies are not accounting for this kind of demand growth. So yeah, it'll be interesting to kind of, understand where everyone's coming from.
Omar, do you think it matters at all, these discrepancies, demand growth forecasts for 2024? As to where the direction of oil markets will go? Your thoughts on the sort of fundamentals of these things and their relevance to the actual oil price and oil market?
Zero, absolutely. If I could say negative, I'd say negative. So they're all arguing, hey, 1.1, no, it's 1.5. I can't tell you how I got it, but I'll tell you it's 1.2. Who cares? Absolutely, who cares? Who cares? And it's not going to change. So in a month they'll say, well, it's not 1.5, it's 1.42. And then another month they'll be like, no, it's not 1.42, it's actually 1.56. Who cares? Who's actually got the time to actually look and say, look at this forecast. This forecast is the reason I'm going to buy. Fuck it. So no, it doesn't matter. It's nice as a background thing, but does it actually matter to the price and all this kind of stuff? No, it doesn't. Because I can tell you one thing, they could come and say, it's going to be 1.6, which is going to be a great surprise to the market. And basically they could come and, a ship blows up somewhere and the price doesn't care. So no, I don't think it matters. I think it's nice for background. Banks maybe look at it when they come out with their projections for the month or for the year and then continually change them because they're wrong by 3,
ultimately
5,
it does
pounds.
feel like the markets, Omar, the trading on the markets have become sort of immune to what were fundamentals, if you like, supply and demand fundamentals, and have become a little bit immune to the geopolitics of the uncertainty towards, risk to supply. What does the market, what do you think is going to give this? Obviously, we've been in this range bound so far this year, although upward, it has to be said. Brent started the year at $76. We're now at 83, and that's 6 weeks. So that's $6-7 in 6 weeks upward. But what is giving the market upward momentum? What will, from your bullish outlook, if it isn't fundamentals, it's not really geopolitics, what's the trigger to get up to 90?
Basically, is the market inflationary or not? Is it deflationary? Some people say, look at China, they're exporting deflation, like they were saying last week, so sell it. Other people will tell you, it's a US dollar, so the US dollar is going to be weak, so buy it. So basically, it's a mix. Everybody has a different opinion, and the oil market has nothing to do. Futures markets, paper, all that kind of stuff. The physical market trades the volume is so tiny that the oil market is basically like it's financialized. So financial flows determine where the price goes. Doesn't matter if it's 1.5 or 1.2 or whatever it is. People will come and buy it, the price is going to go up. People come and sell it, the price is going to go down. It has nothing to do with physical players or fundamentals. It has everything to do with money flows. The reason why I think oil prices are going to go high, or going to go higher from here and considerably so, is because if you look at any market, if you look at exogenous market from the S&P, you look at basically what's pushing the S&P higher. You're looking at the US dollar, you're looking at geopolitics, you're looking at all this stuff. I see no reason to sell it. So what have I got to do? Either I don't sell it or I don't do anything. So I'm going to buy it. It's that simple.
Dr. Serra, last word with you this morning. Obviously, this is an election year, and the price at the pump can be quite a big political issue. And if we take and Omar's outlook, as well as the reality that the oil price has been climbing over the first 6 weeks of the year, where does the election, the activity we saw 2 years ago, a lot of SPR release, etc. Do you see an intersection point between a cap on this oil market and the U.S. administration, or where do those two things meet, you think, over the coming months?
Well, if you look at the politics of U.S. election, there's already a lot of different factors that are going to play into this election. But obviously, the prices of gasoline are important. So far, they are not that high that are concerning. But I would say the inflation, the performance of the economies are more important than the price cap. And I would just like to quickly just because you gave me the last word.
Please, yes.
With regard to that data discrepancy, I think I would like to add the time frame to that. As Omar said, maybe in the short term it might not be that concerning, but when we look at it into the long term and where the investment is going to be there, because investors usually look at the forecast to be prepared for the supply, to meet the demand, and that could be impacted. And I'm going to mention something interesting about methodology. There are so many unknown factors when it comes to long-term demand, because in a classic ways of forecasting, economic growth and population were the fundamentals of demand projections. But now we have new phenomena like AI that no one really can predict how fast it grows and how much electricity or energy demand it needs. So I remain enthusiastic about learning more about all these assumptions and discrepancies.
Or how much AI delivers efficiency in activity and then maybe reduces energy. No is the answer. Will it be the trigger to reignite the Chinese economy and drive prices to $90? No, a big no. But maybe that's a buy to somebody like Omar, that this change of sentiment in China, the change of that narrative, could certainly, I think, be a significant mood music change for the market. But nonetheless, I think you both go to Riyadh today, Amina and Dr. Sarah, with all oil producers with a big smile on their face at $83 a barrel. Everybody, I think, in Riyadh is going to be happy, maybe except Fatih Birol, who doesn't seem to be happy that much anymore. But nonetheless, consumers that he represents may not be so thrilled. But I would imagine we're in the sweet spot, the sort of Goldilocks number in the low 80s. And should make the meeting in Riyadh quite interesting. We look forward to hearing what you guys have to report back from that. But thank you this morning, Omar Najia, Dr. Sarah Vakhouri, and Amina Bakr, for your time and insights. Safe travels. We'll see you all again soon. All the best.
Thank you.
Bye.
And Omar,
Thank you.
Kufia.
Thank you very much. Thank you, guys. Have a great day.
Thank you.
Bye-bye. Bye.